Today we're going to talk about Chapter 15, investing in a different type of securities, specifically bonds. So we're going to look at different bonds. The first main type of bond we're going to look at is what's called a corporate bond. And a corporate bond is a bond that's issued by a corporation. Thus, it's a corporation's written pledge to repay a specified amount of money with interest. Notice the word repay, because with any type of bond, in essence, it's an IOU. Remember, with stocks, you are a stockholder or an owner. Here, when you purchase a bond, you are a creditor or you are lending money, in this case, to the corporation. The corporation is making a written pledge to repay you a specified amount of money with interest. The face value of the bond is the dollar amount that the bondholder will receive at the bond's maturity date, when the bond must be paid back. Usually bonds are issued at par or $1,000 value. However, there are different amounts. Bondholders will receive interest payments, generally speaking, not once a year, but every 6 months. So for instance, if there's a $1,000 bond that pays 5% interest or $50 per year, you'll receive $25 at the end of 6 months and the other $25 at the end of the year. The written pledge is contained in legal conditions. Those are known as the indenture, I-N-denture. Finally, the trustee is an independent firm that acts as the bondholder's representative. So why do corporations sell bonds? They do it for a variety of reasons. To get funds for major purchases, to fund their ongoing day-to-day business activities, when they can't sell stock for whatever reason, to improve what's known as financial leverage, is having more money around. And a major reason is that the interest paid to the bondholder is tax deductible business expense. So remember that $50 of interest we talked about? That corporation can write off that interest on their corporate tax return. Now remember, I said the written instrument is known as the indenture. Notice there's a term indenture and this term debenture. Debenture means unsecured bonds. They're backed up only by the reputation of the corporation that issues it, as opposed to a mortgage bond, which is a secured bond. This type of bond is secured by various assets of the corporate issuing firm, usually real property or other types of property. The interest rate will be lower on a mortgage or secured bond because it is secured by collateral and other corporate assets. Another type of unsecured bond is known as a subordinated debenture bond. This gives the bondholder a claim secondarily to that of the mortgage debenture bondholders with respect to such things as interest payments, repayments, and assets. Another type of bond I want you to know about is a convertible bond. This type of bond can be exchanged at the option of the owner for specified shares of stock or ownership. Finally, high yield bonds, oftentimes known as junk bonds, they pay a higher rate of interest, but also because of that higher rate of interest, you're taking a higher risk of the bond defaulting, hence the term junk bonds. Most corporate bonds today have what's called a call feature for the corporation, which means the corporation can call back or purchase back the outstanding bonds. So usually, going down near the bottom of the slide, bonds are typically called back if the interest rate is much higher than the overall interest rate in the economy. So for instance, if Boeing issues a 10% bond, you purchase a Boeing bond that pays 10% interest, and now 3 years later, interest rates have gone down from the 10% down to 2%, Boeing's most likely going to call that bond back in because they don't want to keep paying you 10% interest when they can issue new bonds at the much lower rate of interest. So a sinking fund is when corporations issue lots of bonds, they got to put money into a fund to guarantee the repayment when the bonds become due, and that fund is known as a sinking fund. Also, corporations often issue bonds ongoing, and those are known as serial bonds. They mature on different dates, so they don't all become due at the same time. So why do investors purchase corporate bonds? Well, there's a lot of psychology involved in any type of investing, including bonds. Bonds are simply another way to use your asset allocation to what we know is diversify the portfolio investment. So you own stocks, you own bonds, you own real estate, etc. Investors who purchase bonds, whether they're corporate bonds or we'll talk about government bonds in a second, they view it as a safer investment as when compared to buying stocks because a bond must be repaid. Remember, you're not an owner when you purchase a bond. You are a lender and you get paid back first. Finally, bonds may also provide more growth and income potential than other conservative assets such as bank accounts or CDs. As noted before, investors receive interest usually every 6 months. So the dollar amount of annual interest simply is computed by multiplying the interest rate by the face value of the bond. So a $1,000 bond paying 5% interest would pay $50. Other things of note with bonds. An investor may, just like with a stock, an investor may be able to sell the bond at a higher price than they purchased the bond for if the interest rate on the bond is higher than the interest rate of new bonds being issued. Thus, there's an inverse relationship between the bond's price and the overall interest rates of the economy. We'll talk about approximate market value here in a second, so we'll skip on to that. So after purchasing a bond, an investor may hold the bond to maturity or sell it at any time to another investor, just like a stock. Other things to look at is yield. Yield simply is the expected rate of return earned by an investor who holds the bond for a stated period of time. Usually that's 1 year, but it could be a different stated period of time. Finally, oftentimes people who purchase bonds use a technique known as laddering. So that's a strategy used to buy bonds with different maturities to balance the risk and return. So let's look at an example of approximate market value. So let's say you purchase a bond from Bank of America, so which means you're lending Bank of America $1,000. It pays 5.5% interest. It matures in 2023, which is at a $55 annual interest, because that's 5.5% of $1,000. Also assume a new corporate bond pays a comparable quality, but pays not 5.5%, but 6%. So the approximate market price of your Bank of America bond simply is the dollar amount of annual interest, which we know is $55, or 5.5% of $1,000, divided by comparable interest rates on similar bonds. Here, you'll see now that your Bank of America bond that you purchased for $1,000 is now only worth $917. And the reason that is because you could purchase today a similar bond and get a higher percent rate of interest, 6% versus 5.5%. So again, let's look at another example here. Now we're going to look at with Apple. So let's make some assumptions. The interest is 3.45%. It matures in 2024. You purchased it 10 years prior in 2014, but you sold it before it got to maturity. You sold it on April 29th, 2018. So you held it for 14 to 15, 15 to 16, 16 to 17, 17 to 18. You held it for 4 years. So let's look at the costs when purchased. Okay, you purchased a bond here and you got it for $990 plus $10 commission, so it was a $1,000 purchase, okay? Then when you sold it for $1,030 minus your commission, you got $1,020 when you sold it. So here you got $20 difference here. So the dollar return was $1,020 when you sold it, $1,000 when you bought it. Profit from the sale of the bond was $20. For those 4 years, you made $34.50 of interest. So 34.50 times 4 years is $138. The total return on your investment is $158. So just like with stocks, you can buy bonds on the open market, okay? Just same thing as stocks. There really isn't much of a commission anymore because commissions have gone down on bonds just like they have on stocks. So now, here up till now, we've been looking at corporate bonds. Now we want to look at bonds issued by another agency, not necessarily a corporation, but here by government bonds. Government bonds simply is just, again, a written pledge or an indenture by either what's called a government or what's called a municipality, a local government, to repay a specified sum of money with interest. And so these can be done with federal, state, or local. Now, when you purchase a federal bond, you don't have to pay any state income tax on the interest you get. However, you do have to pay federal income tax. With a state and local bond, it can be even better from a tax perspective. So with a state and local bond, you don't pay any federal interest. And in addition, you won't pay any state interest income tax as well if you happen to live in that same state. So if you live in California, you buy a California municipal bond, you don't have to pay any federal income tax and you don't have to pay any state income tax because you live in the same state. Let's look at federal bonds first. They can be issued in different varieties. A T-bill is due within a year or less. So you can see the maturity dates are up to 52 weeks. T-notes are between 2 and 10 years. And a treasury bond can be anywhere between 10 and 30 years. In addition, another type of bond you can purchase, federal bond you can purchase, can have what's called TIPS, or Treasury Inflation Protection Securities. They're issued in minimum units of $100, but the idea here between TIPS is that the principal of the bond will increase with inflation and will decrease with deflation. So what it's doing is when we have inflation or the general rise of cost of goods and services, the value of your bond will go up with that. So in addition to our federal government that issues bills, notes, and bonds, debt securities are also issued by federal government agencies, as you can see here, Fannie Mac, Ginnie Mae, and Freddie Mac. These are not actually part of the U.S. government, and so they have slightly higher risk than Treasury securities, so they usually get higher interest rates. Now let's look at the state and local side of bonds, government bonds. Municipal bonds, also known as a muni. These are debt securities issued by either a state or a local government. Could be the city of Lancaster. In fact, our school district, Antelope Valley Community College District, has issued bonds in order to help with the financing of the campus expansion. Usually all municipal bonds are either general obligation bonds or revenue bonds. A general obligation bond is a bond that's backed by the state or local government that issues it, so they guarantee payment. Whereas a revenue bond is repaid from income that's generated from the projects of the funds, its finances. So if you bought a bond that was going to build a toll road, it's going to be paid back with the profits from drivers who pay the toll. Muni bonds, nerd, not as safe as U.S. Treasury or federal agency bonds. Okay. So there have been defaults on state and local bonds. They're a little more riskier than federal bonds. And just like with all types of bonds, they may be callable. Now, the interest earned may be, again, exempt from federal income tax and also exempt from state income tax if you live there. But the capital gain on the sale is taxable, which means if you bought the bond for $1,000 and sold it for $1,030, you made $30 on the sale of the bond. That's not interest, that's on the sale. That capital gains is taxable. So a lot of times people buy bonds for the good tax treatment that you get on this. In order to equate that, you look at what's known as taxable equivalent yield. You can see the numerator is tax exempt return and the denominator is 1 minus your tax rate. So let's use a simple example on the slide. Let's say you live in a 28% tax bracket. You're a person in a 28% tax bracket. You purchase a 3% tax exempt muni bond. So let's take a look. Your tax exempt return is 3%. That's the interest you're not going to pay tax on. That's your numerator. Your denominator is 1 minus your tax rate. Well, we know you're in a 28% tax rate. So we take the 3%, 0.03 in the numerator. The denominator is 1 minus 0.28 or 28%. And so the tax equivalent yield is 4.17%. So in essence, that's how much interest you're really making on it because you're not paying tax on the interest. So where do you go to get information to evaluate bonds before making an investment? Again, just like with stocks last chapter, there's plenty of internet sites that you can look at. Specifically, here are some that you can meander. They'll oftentimes give you the bond information. You can obtain annual reports just like with stocks. You can do that with bonds. And all bonds will have ratings, and they're done by Moody's, Standard & Poor's, Fitch, and Mergent's. And you can see the higher the rating means the less the risk that you're going to have, which means also the lower the interest rate. So Google recently issued bonds, and they're AAA rated. They can issue at a very low interest rate, and people swallow them up because they know Google has plenty of money to pay it back. So let's finally look at some bond yield calculations. Let's look at the simple one first, the current yield. Again, remember, yield is the anticipated rate of return over a stated period of time, usually 1 year. So we measure yield by looking at the current yield first on this slide and the yield to maturity on the following slide. So let's take a look at the current yield first. Current yield simply is the annual income amount in the numerator and the current market value in the denominator. Let me give you an example. Let's say you purchased a bond from Boeing that has a face value of $1,000 and pays 2.85% interest. However, because of fluctuations in the economy, the current price of the bond that you bought for $1,000 is now $970. So you bought it for $1,000, it's currently worth $970. So the current yield currently, as of today on it, you look at the annual income amount in the numerator. Well, you know if the bond pays 2.85%, that times $1,000 is $28.50. So your numerator is $28.50. That's the annual amount of income. Your denominator is the current market value. Well, you bought it at $1,000. It currently is $970. So $28.50 divided by $970 gets you 2.94%. So it's currently yielding more than what you bought it for because it's worth less than what you bought it for. Now let's look at yield to maturity. And you can see this is a monster type of calculation. And I'm not going to make you do this on a test, but I would like you to go to your book near the end of the chapter, and they give a really good example on how to do this. And if you're just yield to maturity would allow you to know if you held the bond until maturity, what's the yield going to be on it based on some assumptions today. This concludes our lecture on Chapter 15, Investing in Bonds.